I am not expecting Wall Street tell me that revaluation, it will happen 100%. I'm not even a teeny weeny bit doubtful of what that future is. What I don't know is what that would be in terms of dollars, let's say, by the time they do that revaluation. But that revaluation will be because the government is attempting to get that confidence back. So that means that inflation has really risen very visibly higher, 50 or 100% or wherever it's going to be. And so they'll lop off a whole bunch of zeros. And I can tell you, if they did it today, and they did it on a one-to-one basis, that it would be north of $40,000.
The World Gold Council predicts that gold prices will rise at an average rate of 5% annually through 2040. This indicates a positive long-term outlook for gold as an investment. Gold researcher Jan Nieuwenhuis has noted for months that many governments and central banks recognize the money creation potential of gold revaluation and provide for it explicitly with gold revaluation accounts. Back in 2012, the U.S. economists Paul Brodsky and Quaintance described the potential of gold revaluation. In this video, Lynette Zang, founder and CEO of Zang Enterprises LLC, discusses gold, silver, and the current state of the global economy. Lynette predicts inflation could surpass 50%, prompting extreme measures like removing zeros from currencies. History suggests that today's fiat currencies are nearing the end of their life cycle. With soaring debt levels, relentless money printing, and rising geopolitical instability, the collapse of fiat currencies seems inevitable. It's a question of when, not if. Even central banks acknowledge this looming risk, as evidenced by their unprecedented gold accumulation. Concurrently, Lynette estimates gold could exceed $40,000 per ounce if revalued one-to-one with U.S. debt today, potentially higher. Despite rising global inflation, Lynette Zang notes that central banks face the dilemma of lowering rates to spur inflation conflicts with the need to raise them to control it. She states excess liquidity from post-2008 debt creation is a persistent issue. Regarding gold and silver, Zang explains their value rises in this environment, even with suppressed spot prices. Lower interest rates are favorable for gold since they increase the money supply. Gold has consistently performed well during high inflation, acting as a store of value. In the 1970s, during double-digit inflation in the U.S., gold prices increased by over 500%. Showcasing its effectiveness in preserving wealth. In recent years, gold has shown resilience during inflationary spikes, including the 2008 financial crisis and post-pandemic inflation surges. Its performance often outpaces other assets, reaffirming its status as a reliable hedge against inflation. Now we present the clips of Lynette Zang's insights from her recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I am not expecting Wall Street to tell me that revaluation, it will happen 100%. I'm not even a teeny weeny bit doubtful of what that future is. What I don't know is what that would be in terms of dollars, let's say, by the time they do that revaluation. But that revaluation will be because the government is attempting to get that confidence back. So that means that inflation has really risen very visibly higher, maybe even to 50 or 100% or wherever it's going to be at that time. And so they'll lop off a whole bunch of zeros. And I can tell you, if they did it today, and they did it on a one-to-one basis, that it would be north of $40,000. By the time they do it, and I know this sounds outrageous to people because they get blinded by the numbers, right? But if you went back to 1913 when somebody had a $20 1-ounce gold coin and said, one of these days that's going to be trading at $2,600 or $2,700, that person would have seemed outrageous at that time too. So it could be 3 trillion, it could be 100 trillion. I personally have a $10 trillion Zimbabwe note, so I am a trillionaire in Zimbabwe, but what does it mean? It means nothing. So if they did the overnight revaluation today on a one-for-one debt for gold ratio, then it would be north of 40,000. I don't think you're interpreting too much into it. I think people aren't interpreting enough into it. And it isn't just in the US. This is a global phenomenon. And the problem is that central banks want to lower the rates. So with the inflation ticking up, it's hard for them to justify that because there's only one way to fight inflation, and that's with deflation. And the way they do that is by raising the interest rates and having fewer people borrow and raising the rates and having fewer people borrow and spend, which is deflationary in a consumer-driven economy. And what they want to do is lower those rates so that they're generating more inflation. And the problem is there's so much cash that's still floating out there from all of the trillions and trillions and trillions of dollars worth of debt that has been created since 2008. It isn't that they created and that money evaporates. It goes into these fiat money or government-based money, intangible assets. And that is very, very good for physical gold and physical silver, because it means that its value, even if they suppress the spot price, which is a contract price, right? It means that is going up in terms of dollars or wherever you are. And we are at the end of this current experiment, which is why you're talking about the meme stocks, you're talking about the cryptocurrencies, all of these things people are rushing to position into, but those are all intangibles. And so while there is a lot of liquidity out there, I mean, what the central banks want to do is ease into an already easy economy, and there's your hyperinflation, right? And when that picks up, the public loses confidence. And
in his analysis, Lynette Zang underscores the unprecedented gold purchases by central banks in 2024, emphasizing their role in preserving financial independence amid the weakening fiat system. According to UBS, central banks continued to be the mainstay of gold demand with their purchases and the heightened global risk premiums driving gold prices. Despite the breakdown in the relationship between gold and real interest rates, these factors have kept the gold market buoyant. Preliminary estimates indicate that central bank demand for gold in 2024 was around 1,000 metric tons, slightly lower than the previous 2 years. The year 2022 saw the highest annual purchase in history at 1,082 metric tons. Furthermore, she expresses concerns about the looming debt crisis across government, corporate, and individual levels, aggravated by rising interest on compounded debt. Drawing parallels to the 1960s dollar run, Zang warns of diminishing dollar dominance and its impact on the global financial system. Let's get back to the interview.
And so if governments can do that, and we're seeing that really, the global central banks have bought more gold now, and we don't have the final numbers for 24 yet, but even going through the third quarter of last year, they've bought more gold than they ever have historically, going back to when they started tracking it, because that's how you maintain your independence and your own personal sovereignty. And why don't we as individuals take a page from the central bank books? Because who knows more about what they're doing to the fiat money than they do? What I'm most concerned about is this massive debt wall, both government debt as well as corporate debt, as well as individual debt that is coming due. And if you can't pay it, then you roll it over, and the interest rates, because this is really why the central banks want to lower the interest rates, is because of this massive wall of debt. In the US, the level of new debt that they're having to issue is huge, right? I mean, it doesn't even dip down a little bit in what they're anticipating is going to happen. But that's why Fed Chair Powell wants to drop the rates, but we've been compounding interest forever, right? So that means that we're not paying any of the principal, and the interest that we haven't paid back goes into that principal, and now we're paying interest on interest on interest. So my key concern is particularly with Treasury bonds, or 10-year notes really, which is the foundation of the global system. And we don't have anybody supporting that, because there is a run on the dollar that is happening right now, very similar to what we saw in the 1960s when foreign governments were sending in their dollars and pulling the gold out of our system. So much so that it forced President Nixon to, they say, close that gold window, which doesn't sound so bad, but it really forced him to hand over, or what he did, I don't know that it forced him to hand it over, but he gave full control of inflation to these private central banks, which to me is insanity, because that's just about debt and interest, and here we are today with officially virtually no purchasing power left.
As the global economic landscape continues to evolve, gold is poised to reclaim its historical position as a primary reserve asset, making it an attractive option for investors looking to diversify their portfolios. Do you believe the current economic challenges will accelerate the shift from fiat currencies to gold and other tangible assets? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.